Continuing with our project, um, as you note here, we have this is our net cash flow after taxes. We've started with our change in earnings before depreciation and taxes. Here's the change in depreciation. Um, this is not EBT, this is earnings before taxes. Um, but that line, again, you just subtract out. Here's the cash flow, subtract out. This is the profit that we would have to make payments on. Here's the taxes based on our tax code. So now we have a change in net income. Add back to that the change in depreciation so that we come up with our change in cash flow after taxes. Next, we have to incorporate net working capital or net operating working capital. So net working investments are often overlooked. Can we assume a percentage of future sales must be invested up front, and ultimately that'll be recovered in the end. However, a more realistic view is that every year we're going to have to invest some money in our net working capital. So that's what's reflected here, because our formula is a percentage of what we think sales will be next year. So when this project concludes, the other thing that we're going to have to incorporate is the cost or the after-tax cash flows of buying the projects. So in this case, you see we bought it for $240,000. In the end, we're going to sell it. That's coming up on the next slide or so. But we have to show that as an after-tax item. So here's the after-tax item. Again, there's a couple of ways to do that. We need to figure out what the book value is that's remaining. The worksheet will do this quite nicely for us when we do the project worksheet. So again, our ending cash flows from net working capital, that's our $26,000 here. After taxes, we're going to recover $18,750 from selling off this project. This gives us our remaining total cash timeline of cashes for this project. Again, in total, here we see how everything flows together. Earnings before taxes, incorporate the change in depreciation. We're going to have to pay taxes. Determine ultimately the change in cash flow after taxes, incorporate our net working capital, the investment in plant and equipment, and ultimately, again, our final cash line. So what do we do with the cash line? What do we do with that timeline? Well, we need to incorporate our capital budgeting techniques. So in this case, we see that net present value is roughly $62,000 odd. Obviously positive, so that's a good project to do. 20% internal rate of return is better than the 10% discount rate, so that's a positive indicator. Modified internal rate of return is also greater than the reinvestment rate. That's great. And then finally, the profitability index is greater than 1. So again, they all confirm that this project is a good project that we should do for the company. So now we have some cash flows. What's the next thing we have to think about? What is the riskiness of this project? In particular, what is the risk that the cash flows that we've predicted don't happen? So risk is the uncertainty surrounding our future profitability. How likely are the projected cash flows to occur? Quantitatively speaking, risk is measured by standard deviation, the coefficient of variation, and beta. So understanding these areas is going to be helpful when we want to understand the risk profile of the company itself. The challenge is we really don't have historical data for our analysis. There's a great deal of subjective judgment in this process. So, you know, it is uncertain at best just because we're making predictions. And we really don't have, for many projects, we have no historical information to base our analysis on. So there are three basic types of risk that are relevant to capital budgeting. Standalone risk, that's if the asset is viewed in isolation. Corporate risk looks at the impact of this project on firm earnings. And then market risk, that's the effect on shareholders that have diversified portfolios. So while market risk is theoretically the most important, corporate risk is often the practical focus that we want to place it on. And the challenge is that is sometimes difficult to do. So each type of risk is going to may suggest different decisions based on shareholder perspectives. So what is standalone risk? This is the basic statistical analysis that we would perform. However, it ignores the diversification of the company and shareholders. So standalone risk, if, as you may remember from previous videos, includes two kinds of risk. That risk that's diversifiable and that risk that's non-diversifiable. So we're going to measure this by the standard deviation or the coefficient of variation of our statistical calculations. Corporate risk looks at the relationship between the project and the firm itself. We need to know the project's standard deviation and its correlation to the firm. In the end, we're going to need to calculate the project's beta. We'll then incorporate that number in the security market line formula we've discussed in some previous risk videos. Market risk. This risk takes a look at the diversification between the project and investors' risk. We need to determine the market beta of the project with reference to the stock market. Quite frankly, this can be a little difficult to calculate given the kinds of information that we actually have. So how is each type of risk used? Again, market risk is theoretically the best in most situations. Unless projects are very different from the core projects of a firm, standalone risk will likely cover the most important aspects of the risk of a project, though. So again, standalone risk is the easiest to calculate. All techniques require a fair amount of data. It is not just the estimation of future cash flows. We need to understand the chances that things may not happen as we think. We need to understand the potential for changes in things like inflation and demand. So that's enough for this section on risk. I look forward to seeing you in the next video.